Well, good afternoon, everybody. It is the end of the day on Tuesday, close of business to be specific. And we've got a fantastic Thanksgiving week show for you. We recruited Ken Hersh, who's the CEO of the Bush Center. He was the longtime CEO of NGP. He's 57. Ken, your bio says 57, but your accomplishments, it looks like you're 87. You've done so much. I mean that in the nicest way. But Ken's going to be our guest today. We're going to talk about a lot of things: energy markets, the Bush Center, everything in between. While Ken gets ready for our hard pitches, curveballs, and sliders, let's just give everybody a roundup on the markets so far. Mike Bradley, you are in Thanksgiving style, patched in from the Birmingham airport, or maybe you've made it to your hotel room now. But tell us what's happening in the markets. We all saw a lot of green. Everybody's feeling better about oil. What do you got?
Obviously, the vaccine happened. The first vaccine announcement happened 2 Mondays ago. You had a vaccine announcement last Monday, and you had a vaccine announcement this Monday. And so, with that, you've basically seen, some people are getting very, very optimistic on demand for 2021. So we got a few charts that, kind of lay this out, and we'll just kind of show you guys what we're talking about. And a couple of things. This first chart we're just showing you is the Brent 1 month spread versus a 6 month spread. And the 1 month is in white, and the 6 month is in blue. And what you've seen is we are in backwardation for the first time in the prompt month. We have not seen that since before, when crude crashed, when the OPEC meeting, back in the early March OPEC meeting, where it kind of fell apart, and we took a lot out of crude oil. We're back there again, and what this just shows you is that Brent has lagged out on the way up. And the second chart we want to show you is kind of what's going on. This is the 6 month Brent time spread, and you can see the blue line shows it's really come up quite dramatically. It's almost back to levels that we saw back in early March before crude oil crashed. And the interesting thing is, you see the purple line. You see that those two lines are fairly correlated. And what you've seen is that we've had a fantastic run in the XOP, but we still have a long way to go. And for just to kind of give you an idea of how much we potentially have more to go here, is these tend to be 90% correlated. And so if you dial in $45 crude oil, it says that the XOP probably has another 25% to go. And if you dial in $50 12-month strip, it's got another 60% to go. So we've come a long way off the bottom, but we still have more to go. And in the next chart here, just kind of give you an idea of what's happened here in the last week. Obviously, the energy indices have all done really well. You've also seen the clean energy index go up as well. So this has just not been a traditional oil and gas move. This has been a move across the spectrum. And as you can see here, the dollar index is kind of out sideways. One of the things I'll point out in this chart is, everything's doing well. The one area that's lagging right now is refining. And so we got one more chart here, just to kind of give you an idea of what's happened here in quarter to date. Quarter to date, energy is the best performing sector. It's up over 31%. The S&P is up around 7.5% to 8%. And next closest gain is in the industrials and financials, and they're up around 14 to 15%. So massive outperformance. As you can see in the subsectors, you have upstream and OFS up over 50%. Clean energy index is run as well, but what you also see in this chart is the dollar index is declined. So what we're seeing here is dollar index is weakening, and so where do we come out on this thing? I think where we come out here is that sentiment has changed for a couple reasons. One, Colin talked about this in the last 2 weeks. Bitcoin is up over 90% in the last month and a half to 2 months. Gold, if you look at it, gold has actually gone down in the last month and a half. And you've seen energy indices go up. You've seen a lot of people are getting really excited about what demand could be next year. And I think what's happening here is a lot of the move we've seen in energy is hedge fund covering, but we are starting to see a little bit of long only money coming in. And I tell you what I think is also happening. I think there's some macro funds that are coming into energy and industrials, and they're going into Bitcoin because I think they feel like there's going to be an inflationary scare next year. And that's why they're putting money in, and that's a lot of big dollars that can go here. So are we going to basically keep going straight up from here? No, I think the fundamentals near term are a little bit shaky, but I think what's happening is the market is really dialing to a really, really big rebound in second half of next year. I do think that's going to be the surprise next year, is that things are going to be a lot better. I think they're going to be more inflationary, and that's what the market's telling you right now.
Let me ask you and Colin before we jump to Matt, what kind of daily demand numbers might people be thinking about next year if we, if these vaccines really kick in and we get quote recovery? What do you think people are thinking?
I can give you an idea of the consensus. What I mean, I think a lot of people were thinking that we would get back to 100 million, and then it really kind of fell off. Several months back, and people started saying, we're not going to get much above 95, 96 million barrels a day. I think it's now starting to creep up toward 97, 98, somewhere in that range. And I think that if you really get a lot of money being thrown at the system here, and you do get this vaccine out there, do we get to 100 million barrels a day? Probably not, but I think that's something that we can start talking about in late 21, early 22, and that hasn't been consensus, and that's what's happened to the market. The market's moved that forward from, probably sort of Q1, Q2 2022 to maybe a Q4 21 type scenario. And you can add to that, Colin, if you think otherwise.
Yeah, no, I think that's exactly right. Think about it. The consensus view, which we agree with, is that you're probably going to have 92, maybe 93 million barrels per day when all is said and done as the average for 2020. And so it might sound like a lot to have 4 or 5 million barrels per day coming back in 2021. But remember, pre-COVID, jet was about 8% of the market, 8 million barrels per day. And so to have 50% off the market now, and if that comes back, that's how you can get this rush of demand pretty quickly.
Colin, guys, what about we're all going to use Zoom? Nobody flies anymore. You guys are forgetting that. We've changed our lifestyles forever. I'm teasing you.
Yeah, the one thing I'd also say, Maynard, and Colin said this in the last couple of weeks and the last couple of months, as a matter of fact, it's just not energy. If you look at other industrial commodities like copper is hitting all-time, not all-time highs, but 4 or 5 year highs right now. So it's not, energy has lagged. It is now catching up. And so I think there's some macro money that's looking at that right now. They're not all in yet, but there's going to be a backdrop for that in the next 4 or 5 months, in my opinion.
Okay, great. Matt, let's hit you. You're obviously head of research, so you see it from all angles. What are you feeling? And by the way, fantastic Christmas tree.
Thanks, man. Yeah, I mean, I think I agree with Mike's comments. I think initially when the vaccine news came out, there was some optimism around it, but it didn't necessarily translate into an immediate rush to want to engage in discussing either micro or macro specific topics. I think as clients have thought through it and looked out to 2021 with constrained supply and are starting to hear comments from OPEC around potentially pushing curtailments out another 3 to 6 months, it's starting to help, I think, the broader sentiment in 2021 from a macro perspective for crude. And that's really starting to filter into the stock because, quite frankly, the stocks were already at very discounted valuation levels. If you kind of step back 2-3 months ago, whether you were looking at refining or midstream or upstream, really all the equities were discounting a very dire situation. I think a lot of that had to do with fund flow and really just a lack of interest in the sector. And we're starting to see that change. Right now, we're seeing the most interest, I think, initially in midstream because that really was a sector where you had a nice yield behind it. And as the macro backdrop improved for upstream, your counterparty risk was lessened. And potentially as we step out over the next few years, you get a little bit of growth back into the system. We're now seeing clients engage around the integrateds, particularly the US and European integrateds, as well as the large cap upstream E&Ps. And then in refining, as Mike mentioned, fundamentals haven't really turned on the near term, but as you step out 12 months from now and you see an improved demand backdrop with where some of these equities are trading and where the yields are, we do expect to start to see capital flow back in. I think the big picture, though, on energy across the board is even though we've had a rip-roaring rally here over the last 2 weeks, it's just the beginning of what we could see from an upside perspective if we do get back into a $50 world. It's hard to kind of discuss specifically on each subsector, but as you look through 2020, we've seen a lot of costs coming out of the system. A lot of industry participants have fixed their balance sheets and are working to fix them further in 2021. We're seeing G&A and overhead come down. And quite frankly, the industry as a whole is going to be in a healthier position when this recovery comes through. And so as we start to see the flow through of that incremental cash flow, I think you're going to see a big uplift to the equity. So right now, I think we're in Mike's camp where things have run But it's time to start looking at picking spots and actually adding to equity exposure versus playing defensive, which has kind of been the playbook over the last 6 or so months.
Two questions, Matt. The price that seems to be embedded in upstream stock valuations, that would be one. And the other one is, do you think we have a 2021 shaping up that the energy complex is going to outperform the broader market, or are you starting to get that optimistic? So
it feels that way. Simplistically, we still have a lot of energy equities that are down between 30 and 60% this year. And as we look forward in a $50 to $55 commodity price environment, the margins for the industry as a whole will look pretty similar to what we saw kind of in a $55 to $60 world. So that recovery over time should actually reflect equity prices that we were seeing a year or two ago. In terms of the upstream stocks specifically, we're still in kind of a $40 to $45 scenario and what they're discounting. And what's interesting is you roll through kind of a $50 to $55 upside case. A lot of these equities potentially are going to see 50 to 100% upside from here. And that's in a fairly conservative scenario where I think clients have increased discount rates and quite frankly have applied a higher terminal risk value to the stock. So as the industry starts to pay out a higher yield and as we move forward, especially as value investors re-engage in the space, the combination of fund flow and just the broader multiple compression as well as just the strength of the financials for the industry, I think are going to drive these equities materially higher.
Okay, awesome. Colin, let's hit you, and then we're jumping to Ken. Ken, I was thinking those returns Matt was talking about, those are like private equity type returns.
Back in the day.
Back in the day. What do you think, Colin? What would you add before we jump to Ken?
Well, with the Thanksgiving holiday coming up here in the United States on Thursday, I thought for this week, let's go to a potpourri of data points. There's just so much that's changing here on the margin. Let's try to put it all on one piece of paper to try to get our arms around it. So starting at the top left, world oil liquids demand, we put at just under minus 10 million barrels per day year to date, year over year. But this is rapidly increasing. We still have 10 days left in November, then all of December. And so like we said, that number could be closer to 8 real fast. World oil liquids production down 10.10 in response. Pretty good indications that OPEC Plus is going to roll over the supply agreement. So you can see there a emerging deficit market and draws on inventory. We do see the draws on inventory. Global crude stocks on the water as of November 22nd, 1.017 billion barrels. Now that may sound like a lot, but remember that's your working inventory on the boats, on the water, the conveyor belt moving the product around the planet. That number was 1.322 billion as recently as May 3rd. So a very substantial draw, much larger than you might think if you look only at the DOE statistics. If you look at these next three panels, Pad 2 refinery activity is much more substantial than what we're seeing in the other pads on a utilization basis, 82.6 versus 78 in Pad 3 and 70 in Pad 5. Up here in the middle, the line chart shows we're heading in the right direction for runs, but we're still below normal by about 12 percentage points. So Pad 2 is doing a lot of work here. It's a good bid for heavy sour barrels, particularly from Western Canada. We're seeing a little bit more distress in California. But when we look at where production, of course, is coming from the United States, it's been a lighter, sweeter barrel in recent years. And it's really just grabbed our attention that Minnesota, Wisconsin, the Dakotas now are really calling crude inputs that look much more like what's traditionally gone into those more complex refineries in Pad 5. Here you can see the APIs on average for the crude inputs, 26.5 average in August for Pad 2B, as we call it. When we look at other producers in the world, of course, Venezuela's production is still close to a 75-year low. Iran's oil output lost to sanctions is about 2.3 million barrels per day. We have that open question on what the Biden presidency and administration will do about that, if anything. And oil output from Saudi Arabia is down 2.6 million barrels per day. Quickly moving through demand, crude runs in China are back to a new all-time high. So all of the COVID damage is gone. We now have 14.14 million barrels per day of runs. U.S. crude exports last week were 2.75 million barrels per day. And in the most recent data we have for crude exports to China, that was 571,000 barrels per day. coming off a peak closer to 1.2 million barrels per day. What's the punchline? We still have the phase one of the US-China trade deal. And if that deal is still intact, 2021 brings a promise at $45 crude for an additional 2.1 million barrel oil equivalent per day over 2017 to be sent from the United States into China. Now, that could be in the form of propane, LNG, crude. It is deliberately vague, but that's obviously a big number. Not getting a lot of help from India right now. There's a bit of a seasonal effect here, even though it's on a year-over-year basis where you see this minus 16%, just given some of the pattern of disruption of demand this year. We're seeing some deeper maintenance in India right now. Crude runs at about 4.37, and Saudi shipments into the United States are down 28% versus the 2019 average. Last week, we went through the COVID statistics in some detail. The case fatality rate, as projected, is about to fall through 2% in the United States. Probably happens within the next 5 days. World is a little bit behind that at 2.36. What that means as a practical matter is somewhere between 230 million and 1.08 billion people in the world have had COVID. And as we've gone into the lockdowns, we're beginning to see more and more stories about the consequences of the lockdown. So two that jumped out at me this week, we're seeing this statistic about skipped vaccinations also burble up again. That number is 117 million children in the world skipped vaccinations for measles, diphtheria, hepatitis, and other pretty serious diseases. And there was an article in the Houston Chronicle over the weekend talking about the number of students who are falling behind in their studies, in some cases because they just don't have access to Zoom and online technology. In other cases because it's just not a system that works for them. Not to single out Houston, we could pick any metro region in the United States, and we're seeing some deterioration on the margin there, which is problematic for all the obvious reasons. Now, back up here in the top right to wrap up, one thing that I noticed this week looking at tanker rates is Aframax rates from the Caribbean into the UK, $2.05 per barrel. That's a huge surge from normal for what is a relatively short trip. It actually is now equivalent to the VLCC rate for UK to Singapore, obviously a much larger trip, a longer trip, and that number is going in the opposite direction. It's falling. West Africa to China is now $1.30. The reason I bring that up, that's also represented here in the line chart, is when we had the Saudi promise for a price war back in March and April, we did see the Saudis put a lot of oil into tankers and to park it there, floating storage. You got a huge bottlenecking effect that was visible in West Africa to China tanker rates. Here you can see they got up to $8 or $10. And think about that as a percentage of the underlying commodity as it dived into the 20s and the teens. And the point is we've really resolved a lot of those issues. So the big draws in moving the stocks off the water is giving us some relief through all of these logistical systems. Right now, we're seeing a bit of a pause in the strong rate of growth in runs in China. So this 14.14 million is actually a slower rate of growth than we saw a month or two ago, but in part it's because of some refinery maintenance. And one thing that I thought was interesting is at the money implied volatility in crude is now back to the long run average. So that is a really positive sign that we may be able to see an uplift in prices. And where we see what we just talked about, those inflationary impulses coming from, of course, central bank liabilities as these balance sheets get inflated to the tune of an $8 trillion increase for the four major central banks. That's the Fed, People's Bank of China, ECB, BOJ. That's a 39% increase year over year. It's now a $27.2 trillion collective balance sheet. The Fed would have you focus on the five-year forward expected U.S. PCE inflation metric. That's at 1.77. In other words, not a problem. And yet, y'all know one of my favorite indicators of the real world is potato chips, because we should not eat them. We all do. None of us pay attention to the price. They're up 14.8% year over year. And as Mike mentioned, technically intraday today, the Bitcoin price was up 100% since its September 9th level. And so putting all those pieces together, final chart that we haven't talked about is this is a representation of China's balance in the crude oil market. A movement to the left means a deficit. as the market is in deficit to the tune of 10 million barrels per day. The Chinese have to go into the world market through imports to fill that gap. And so here we have a system where imports as a percentage of runs is now routinely above 70%. And as you can see, this is a huge difference from the past. And so this will not change anytime soon. It may change at some point in the future, medium or long term, but all of this suggests that what the markets are telling us about the potential for higher energy prices in 2021 is supported by fundamentals.
Okay, fantastic. That was like, wow, what a world tour. I think the whole family is responsible for most of the potato chip inflation. Ken, wow. First of all, thank you again for joining us. We're really lucky to have you as a friend and so thrilled you joined us. Maybe one place to start, the Bush Center. What are you guys working on? What are the things you're focused on? And what has it been like at the Bush Center going through these last 6 months?
Okay. Well, first of all, thank you for having me. This Thanksgiving, I have something particular to be thankful about, and that is still being alive. Tomorrow marks 7 weeks since I had open heart surgery, emergency open heart surgery. I had a 5-way bypass operation, and I'm doing well, and I'm through week 5 of rehab, and I have not had a potato chip in 7 weeks. I have not had red meat in 7 weeks. I've lost 15 pounds, and I'm going to be a lean, mean fighting machine when I'm by year end. So I'm very thankful this season to have regained my strength and trying to maintain as positive an attitude as I can along the way.
Well, I speak for all of oil and gas country when I say we're so glad that you weathered all that, and you're nice to share. And it's a heck of a rally. It reminds me of this energy rally. We got a Ken Hersh rally and we got an energy rally at the same time.
That's right. Maybe Colin can index those charts to October 7th, which was the day of my operation. We'll see.
Okay.
Maybe I can be either a leading indicator or not. Anyway, so I left NGP at year end 2015, so effectively January 1st of 16. And in the spring of 16, I took over as president and CEO of the George W. Bush Presidential Center here in Dallas, which is a right of center think tank. We have the museum and library museum with the archives and some of the historical artifacts from the Bush presidency. But the lion's share of the time that we spend is thinking about policy issues, both domestically and globally, around kind of the Bushian, compassionate, conservative themes. And those themes boil down to economic and political freedom, less government dependency, and being a strong and compassionate country in home and abroad. And domestically, we focus on economic growth, we focus on immigration reform, we focus on education reform, we serve our veterans, we have a lot of veteran services and well-being programs and leadership development. And then globally, we focus on global health, freedom and democracy promotion, and women's empowerment. Now, some of those issues that I just ran through have not been that popular during the Trump administration. Immigration reform is not something where we would line up more with the moderates or the left of center as opposed to the last 4 years. So the same thing on education reform. Veterans, I think, are always important to take care of, and virtually every administration sees that. And then global health, we're big advocates of being participants on the global stage. We're not retreaters from that. And then we can't forget the soft power that foreign aid and things like President Bush's example with PEPFAR demonstrated the goodwill of both our country and the soft power of what it means to do something humanitarian around the world. And when people are quoting if you were taking a poll of men on the street, what you think our foreign aid budget is, people would say, oh, it's 20% of the federal budget, things like that. And the number is like 1 to 1.5%. And the amount of progress that we make with that 1.5%, you send them humanitarian help today, and you don't end up engaging with guns later. So $1 today avoids, literally thousands of dollars later on, and extremism and all that. And that's been pretty empirically proven. So we want to be a good voice for that. And again, that's lined up more with left of center than right of center the last 4 years. So to answer your question, Maynard, we've kept our head down, and President Bush's voice, I think, is an important voice because he doesn't use it all the time. And we spoke out on the social unrest this summer. We were early to congratulate President-elect Biden, and I think that those kinds of demonstrations of civility are what is missing on the political sphere. And I think President Bush really sets that example, and we sort of feed off of that at the Bush Center. So I've enjoyed over 4 years there now, and to me it's been a logical extension of the energy business. When you sit here in the energy business, this call is a perfect example. And I'm not a geologist or geophysicist or a petroleum engineer. You don't want me anywhere near an oil and gas well, but in 10 minutes about talking about energy, we start talking about global trade and geopolitics and politics and microeconomics and macroeconomics and a worldview and history. And so this is kind of a nice little extension for me intellectually. And it's nice to work on some issues with some really great people.
Well, one question for you. There was so much in there, and I'm going to make sure our young people saw that last comment, because a lot of young people today are wondering, which industry do I choose? And you rattled off why energy is so fun and unlike almost any other industry. But President Bush, it must be remarkably hard to be a former president and not say anything. But he seems to have overachieved, honestly, in politely and pulling himself away from it when he could obviously get involved. Is there anything from working with him that you would share about his views on all that?
What I've heard him describe publicly is that he learned about being an ex-president from his father, and he had some times where he may have called his father and said, "What do you think?" And his father's response was, "Doesn't matter what I think. You're the president." And I think that it's hard enough. And again, I'm just repeating what President Bush has said publicly. It is hard enough to be the president of the United States. You don't need the formers poking at you. The rest of the world gets confused when they hear that. And so President Bush has such respect for the office of the presidency that he doesn't want to undermine it. And at the Bush Center, we want to do the same. So we've been very careful about sticking to values, sticking to principles, and not focusing on individual policy elements, because those could get blown out of proportion. And so what President Bush has done is he's spoken with his action. He painted wounded warriors, and he has a very close relationship with the veteran community and the wounded veteran community. And we do a lot of work with wounded vets in making sure that they have successful transitions to civilian life, all veterans, in fact. But we also make the point that wounded veterans are wonderful assets. They're not some sort of handicap group, that these are warriors who served our country and have a lot to offer. And he painted them, and that artwork has been on tour. It's been to Houston, in fact. And so that's a way that he can express himself. And then we have the next Bush exhibit will be featured in March of next year, where he's painted 43 immigrants. And it will be kind of the tip of the spear, if you will, to make the point that we're an immigrant nation, that we're a welcoming nation, and that immigration has more positive benefits than negative benefits, negative costs in our economy, and we should be a welcoming country, and that the immigration rules are broken, and we need to revise them and reform them. So again, President Bush will be able to use those paintings as sort of the beginning of his mouthpiece, and we'll be behind that with policy recommendations and other things, and doing what a think tank should do, which is representing good core values and seeing if we can move the needle and change the narrative.
Do you, as you think about the next year or two and think about maybe picking up another issue or adding another scholar or having another sort of exhibit or conference, what's on your radar that might be a new thing? I don't want to get you too far ahead of yourself, but I'll throw out one that's striking in all this. It doesn't matter what you're talking about. People just don't think national debt and deficits and the tab matters anymore. And Colin, your numbers, if I heard them right, we added 8 trillion and those 4 banks, and we're in the 30 trillion for all of them. Like it's insane what we've borrowed here. Is that something that's on your radar, or what else is on your radar?
You know, in the economic arena, we focus on economic opportunity, and we want to make markets work for more people. In order to make markets work for more people, one of the things that is necessary is fiscal restraint. And to your point, I mean, I personally worry about it. Household debt isn't a problem until you can't service it. And the next month is a real problem. The prior month, not much of a problem. And the same thing can happen with this country if we're not careful. And I think that we've been supported by the Federal Reserve, but there's a limit to the scope of the balance sheet. There's a limit to what securities they can buy. Eventually they're just going to buy such stuff that their portfolio even becomes jaundiced. So I think that, I worry about modern monetary theory becoming sort of a mainstream kind of thought. It seems more like it's an enabler. It's something that people can look to as to something, hey, that'll justify what we do. But, we'll leave that to the economists to see. The thing that worries me the most is increasing government dependency. Mm-hmm. And that's the flip side of fiscal irresponsibility. Mm-hmm. And, we saw this in Guatemala, where they can't afford their benefits anymore. The government says we're just going to have to cut some of these programs, and they burn down the parliament. I mean, it's really hard. It's really unpopular to take something away once you've given it to them. And the dignity of work and the personal pride and value that comes from creating and supporting your own, I think, that to me is so essential to the American experience that it really troubles me when the answer to everything is to go back to the trough. And that trough obviously will have a limit at some point.
One of the other ones you mentioned in the upfront was, and I forget exactly how you put it, but basically individual freedom and boy, this feels like this was a bad year on the freedom index. Now, a lot of things we did, we needed to do as a society, and everybody understands that, but boy, is that something that you're kind of watching? Because we just seem to be, to your point, getting the government and its checkbook involved in almost everything.
Right, and that we are definitely watching that. I think that the United States has to be careful because we're able to project a moral authority around the world because our democracy works, and economic growth it produces good, solid economic growth. It increases opportunity. It's not perfect by any stretch. There are people that get left behind. We need to make sure the safety net is exactly right. We need to make sure that the market rules are fairly applied and are justified and carefully constructed. But I really worry that if we don't have our house in order, it's really hard to project to the rest of the world what they should be doing. And so it's really hard for us as this country to say, you can't put everybody on the government dole when that's what we've done, And so I think that the next phase in governance is really, empirically, let me back up. Empirically, authoritarian regimes have died of their own weight. Okay. And we've seen a rise in authoritarianism. And one of the best counters to that is to have the fact pattern in the United States, where everybody in the world wants to get into to come follow their opportunity set, have that be the beacon again. And so if we bog ourselves down with too much debt or too much regulation or having markets that don't work, or having immigration rules that are completely broken and not serving anybody, frankly, either the immigrants or our country, those are the kinds of things that I think have ramifications. And so that's what my antenna's up for.
Well, I listened to all that, Ken. I think it's like we got some work to do. And
I'd say that the early Biden picks for his surrounding team actually encouraging. I mean, the fact that the fact that the far progressive wing of the Democratic Party is upset, to me, that doesn't break my heart. I think President-elect Biden will be boring for a while, and I think our president should be boring because there's a lot of work to do, as you said.
There's something to be said for boring.
Yeah.
One question, you heard the lead in from the guys on what's happening in today's energy world and some of the themes, and you saw NGP from 1988 to 2015. So that's an incredible span. You think about all the things that happened between 88 and 2015. You saw us go from completely dependent on Mideast oil to being energy independent. You saw the natural gas revolution, the fracking revolution, everything that's taking place. And I'm just barely scratching the surface. As you look at today's energy landscape, is it really a new world? Or when you replay this tape, the rumors of oil's demise have been predicted many times. We've heard the rise of alternative energy many times. I'm listening to the forecast for next year. 100 million barrels a day doesn't sound like something with zero terminal value. So I'm just curious, as you listen to all that, what's your take?
Well, I think the shale revolution created a new normal. And so what you didn't reference in the things that we've seen, and you've seen these too in your career, because it's mirrored pretty much the same time frame, is massive swings in commodity prices, massive swings in the health of the companies who are playing the game. So thinking about it like a private equity focus, I don't look at kind of, Matt presented a really good focus on what's happening in the markets today and where this pendulum is swinging as momentum has now moved from bearish to more bullish. But as I look at it over kind of 10-year chunks, I think that the unconventional shale revolutions changed the way we think about energy. That before the shale revolution, oil and gas was a finite commodity. And if you could find it, you were the king. Because if you had it, people were going to be short eventually. We were talking about short reserve lives. We were talking about really obscure places that you had to go get it from with really high political risk, et cetera. And that's all changed now. So we've moved from thinking about oil and gas as a finite commodity to oil and gas in our lifetimes, it is an infinite commodity. There is zero supply risk. Okay, we know where it is. We know what the costs are to get it out within $3 to $5 per barrel. We don't have to go to the edge of the earth anymore. We don't have to go to weird countries anymore. We can go 200 miles from where the people on this call are, and we can find more oil and gas than we know what to do with. And that's true up and down our continent. That's true up and down, our hemisphere. So the question is, the world is now an enormous oil and gas hydrocarbon storage. Okay. So when I look at it, I do see that the COVID rebound is going to be impressive because it's coming off of a 90. And when that turns back on, people will be talking about 5 and 10% growth rates. We're not at 1 and 2% anymore. Those are big numbers. But I do see a few things happening that we can't forget, because what we have seen this movie before. If oil prices go materially towards 60, Matt's right about bringing cost structures down. And just like in 2014, when the Middle East thought if they took oil to $80 a barrel, it would put all the shale drillers out of business. And they took it below 80. And what did the shale drillers do? They took their cost structure down to 30. It was unbelievable. And it wasn't until there was extreme pain did you see a supply contraction. So I think when oil goes back up, the profitability is going to go up, and you're going to see a resurgence in supply. And there's a lot of supply that's sitting on the sidelines. So we have the Middle East supply sitting on the sidelines, the Iranian supply is on the sidelines, and we probably have 2 to 3 million barrels a day of Permian supply that is 6 months away from being turned back on, maybe 6 months to a year. So, and then you have Russia. There's just more supply that we could on this call count 10 to 12 million barrels a day of supply on the sidelines. So I think that there will be a cap on the on the rebound because I think the market's going to appreciate how fast supply can come on. And at the same time, the energy transition, don't underestimate one thing about the energy transition. Oil we may not be at 110 million barrels a day of ultimate peak oil demand. It may be 105, and then it may go from 105 to 100, but it's still 100 that has, with big decline rates and everything else, so that we need a vibrant industry. So we need prices to be at that clearing point where capital gets deployed. However, there's one thing that's happening that scares me to death. The capital sources are beginning to treat oil and gas like casinos and tobacco.
Yeah.
And so in my world, in the private equity world, okay, it's not hedge funds and people who can dip in and out, index funds and whatnot. The long-term capital providers, you're going to start to see a matching and a thinning. You're going to see a thinning of people who are actually willing to take a 10 or 15 or 20-year hold on energy, and that population is going to shrink. And so you're going to see people in the private equity world be sort of matchmakers between the oil and gas assets and those capital providers who want the cash flow, who understand the asset, who can politically have the asset. And it's not just equity. I mean, the debt markets, you're seeing banks around the world start to talk about not making energy loans. It's not just coal. I mean, coal is, coal's first, but that to me is the biggest risk of the energy transition actually hurting oil and gas. What that does to prices, we all know it'll go up because there'll be less. You starve the industry for capital, and you're going to end up with shortages.
So Ken, we totally agree with you. That is like it's a huge risk. It's risk number one. What should the industry do? Because you kind of instinctively react in a number of ways. So, one is showing the world how much we do for the world, and we're much better in so many ways than the world. You fight the perception argument. That's one way. Another way is politics and policy, and you fight it out in Washington, et cetera. A third way is we just get more profitable, and if we make people money, then that tends to cure things. But it is a big time risk, and the opponents of oil and gas know it, and that's why they've been seemingly so successful in this area. What can the industry do, or the world do, to not go off this cliff that we're seemingly going to go off?
Well, unfortunately, I think humanity is really good at putting out fires, but we're not good at fire prevention. Okay, so we've seen supply shocks before. Case in point is the California power crisis of the early 2000s. Right? They outsourced. They said we want to terminate all of our power generation in the state, and they outsourced their emissions to Wyoming and Utah and Nevada. And then they get caught short, okay, because they have rapid demand growth and they don't let their utilities actually hedge long term. So then they end up with this big shortage. And guess what? Gray Davis comes out and says, I permitted 3 power plants today, and it was drill, baby, drill. And so all of a sudden, when there's a crisis, people have a chance to change your mind. So as an industry, I would say our first job is to be super, super responsible operators, okay? I mean, the early, think about the early Appalachia, examples of the people dumping stuff in the creek. And I mean, that doesn't help anybody because they'll jump on anecdotes. We need to be really perfect in operations because it's an environmental question. Okay, so the first thing we need to do is be great stewards. And I think our industry does a pretty darn good job of that. But as a planet, we don't. But the United States operators do. So number one is the industry has to be very responsible actors themselves. And we can control that. Okay. The second thing is you don't stop making the case just because nobody's listening, because when the crisis happens, we're going to say, we're here and we've been here and we haven't left. And so that's when people will say, boy, look at these, we're not coming back to the industry when it becomes fashionable. We're going to say we never left. And so I think your first point of just maintaining our discipline, maintaining our messaging is really critical. And then the third thing is don't lose too much, don't over argue it. Because for people on the extreme environmental, case, it's practically religion to them. And they don't necessarily know the numbers. They think electricity and oil are the same thing. I mean, they just, it's a completely different mentality, because if your answer is, you realize if you take all the coal offline in the world, we'd have no manufacturing. And they would look at you and say, so what? I'm trying to save the planet. We'll make do without as much manufacturing. And so it's really hard to make those arguments when that claim is really a higher purpose. And I'm not for a bad environment. I mean, I think the hard part about being an energy guy, you don't want to take the opposite side. We all want clean air. We all want to be responsible, and we want to be more gentle on the planet. And so I think we need to be players in that game. I think the major oil companies are doing a good job because they're starting to talk the talk. I think the major auto companies are, but if you're General Motors and you're part of an industry that sells 20 million, about 40 million cars a year globally, and a couple million electric vehicles go on the road, it's rounding error, but it gives you something to talk about. So I don't want to be flippant about it, because it's serious this time, and it is gonna restrain demand growth. But I would say we just need to keep the faith, keep doing what we're doing, and maintain our messaging.
Well, I think also we need to do what we just did is we need to talk about this risk openly.
Right.
And I think that a lot of people perceive and understand this risk, especially if you're in energy, but not so much as you leave the industry's boundaries. So we should keep doing that. Is energy, is that something that's on the Bush Center's radar from a policy standpoint, or what?
Well,
how do you feel about that?
It's on my radar. And I think that we're very pro-market economies, and the unconventional revolution in the United States has made us one of the lower cost producers on the planet, and that's a good thing. And if we can help remove some of the externalities and let the markets work, it is amazing what would happen. And so the U.S. oil and gas industry has been a huge engine for economic growth in the last decade, and without it, it would have been more stagnant than it was. So I do think that people are starting to understand the numbers, because they can see what happens. They could see the impact when oil went to 40. They could start to see what happens when U.S. oil production and employment in the industry and the velocity of money and all the things that happen in our industries decline. So I think that again, you can make the case, but people have to experience it firsthand.
One thing that I think everybody would find interesting in the audience, I've seen it before, is you've talked a little bit about the Bush Center, and you traveled and looked at other presidential libraries and think tanks, and so you've thought through the economics, if you will, and the business of being a think tank. Would you mind just sharing some top line observations from all that? Because I think people would really find it interesting.
Well, from the outside looking in, I usually I'm on the board of overseers at the Hoover Institute, and I'm active at the American Enterprise Institute also. So I sort of looked at think tanks as research houses that had smart thinkers, and they would write policy papers and nobody would listen. Being on the inside, actually, what I found is that the think tanks themselves are actually an incredible cottage industry of value in this country. And the policymakers, if you think about what a congressman or a senator has to opine on or vote on in a normal session, they're being asked to have an opinion about a wide swath of things, and they have a little attention span. And they have so many demands on their time. Their staffs are really important, but the staffs are young and they're inexperienced at times. And so I think that the think tank community does provide this sort of shadow information source. Now there's lobbyists, there's the lobby community too, and that one has a lot of issues. And so I'm a fan of the think tank communities, both on the left side and the right side, as opposed to the individual lobby organizations, because those lobby organizations will spin, and their job is to spin. And I think the real relationships where you have a lot of former government officials that find their way into think tanks, it's not full of academics all the time, and there's a lot of experience there that really doesn't call it the political industry. So and there are good ones and less good ones, but generally speaking, they're important assets.
It's really exciting to have you on the show, and given your wealth of experience in the private equity industry, I'm just curious how you think the private equity business model might evolve as it relates to energy. It's a question we get a lot from investors, and I think they're quite interested in how things might progress over the next 5 to 10 years.
Yeah, I'll go back to my comment about it's driven by investors. In the private equity industry, the growth in it, we're basically matching assets with investors who want the exposure, and the endowments and foundations and pension funds and sovereign wealth funds, and a whole bunch of people, in the family office world. If that starts to get more narrow because people are starting to leave they don't want oil and gas exposure. We've seen a dramatic decrease in the endowments and foundations appetite. Sovereign wealth funds, not so much, but that stuff starts to change. And I think I think the private equity firms are going to adapt, and they're going to adapt in 2 ways. One is on the oil and gas side, they're going to be less levered. They're going to be more operations intensive. They're going to be more cash driven, and they're going to find those investors who want that and are happy to have that for a long period of time. You're also seeing the private equity firms start to begin in the energy transition area. And that's demand driven, that the capital wants that. And frankly, the energy private equity businesses, those professionals are as close to the numbers and as close to the action and close to the feasibility as anybody, because they know what what the energy transition is trying to make uneconomic, right? So, if somebody wants to try to make oil uneconomic and their alternative is $80 a barrel, and what profitability is at 50, you're a good judge of that technology. So I think that NGP, under my watch, we had 2 energy technology funds. Now they've started a 3rd. I mean, that's just one example, but NCAP has one. And I just think you're going to start to see the private equity firms fill that market demand. But back to oil and gas, I think you're going to see it less levered, more operating oriented, and longer term holds.
Maybe if I could just pick up on that theme of adaptation. Not only did you co-found NGP, but you also founded the Global Adaptation Institute a decade ago, 5 years before Paris taught us this phrase, adaptation and mitigation. Can you, give us a little insight on how did an oil and gas guy get 5 years ahead of Paris?
Well, because I knew the numbers, and I knew that when solar power was 0.1% of electricity demand, tripling it or quadrupling it would do absolutely nothing to the environment. I knew that ethanol was an interesting political creature, but it sure wasn't doing much for the environment. And if you look at what was happening, the enormous amount of attention that was put on very, very small, I'll say inconsequential, less consequential activities, that to me was the wrong thing to do. The climate industry was focused on getting 196 countries together. Heck, 196 countries couldn't agree on what to have for breakfast tomorrow, let alone a 50-year plan costing trillions of dollars with no enforcement and mixed costs and benefits. I mean, it's ridiculous. But it was a fun industry for a while because you got to go to places like Kyoto and Bali and Copenhagen and Cape Town. I mean, it's wonderful. But I tell you, if they met in the middle of the desert somewhere, it wouldn't have been so wonderful. And what was amazing to me was if you knew the numbers, you don't need 196 countries. You needed two, China and US coal. If you focused on China and US coal 20 years ago, 10 years ago, you'd solve the problem. We could have and should be engaging in the greatest trade deal of all time.
Yeah.
Zero technology risk, zero. We should be helping to convert Chinese coal plants to gas-fired power plants. And at the time, GE and Siemens China could do a 50-year power purchase agreement and finance the heck out of it. And there's more LNG coming on, and there's plenty of gas everywhere. And over 10 years, you could obsolete the entire Chinese coal business. Yet we spent 30 years, going back to Kyoto and before Kyoto, trying to get up to Kyoto to get to the Paris Plan, which was a $13 trillion no enforcement plan with one huge fact that nobody focused on, was that the Paris Plan allowed China to increase their emissions, okay, by 5 billion tons of CO2 per year, the equivalent of the entire United States. That's about what the US is about 5.5, okay? So imagine if we said the US could double emissions, people would just go nuts. But yet Paris allowed China to increase from 10 billion to 15 before they declined, okay? It actually allowed the top 5 or 3 of the top 5 emitters to increase, which is crazy if you believe the preamble that says we got to do it now, we got to do it now, we got to do it now. And we're past the point of no return. So I focused on Americans being a leader in thematically saying humanity has a wonderful track record of adapting. The world has 50% of its GDP within 25 miles of the coastline, all over the world. And if the 100-year flood is now the 20-year flood, then we should not be focused on little tiny things. We should be focusing on we might have to move populations, okay? We might have to fortify areas, but those are decades. Those projects take decades and they take billions of dollars. And if you believe the models, and I do believe the models, the one thing we don't have is time. And we've wasted 20 years, okay, calling the people who focus on adaptation deniers. And in fact, we weren't deniers, we were acceptors. But now if people would, again, during COVID, we've seen a dramatic drop in emissions, right? So if you want to drop emissions, shut everything down. Well, if your job is to save the world and save humanity, you'd say, well, that's a cost I can deal with. But the average person can't. So anyway, so I took it on myself and had a wonderful team around me, hired the number 2 guy out of the World Bank, Juan Jose Dabub, to lead it. We had an international following. And at the end of the day, the climate lobby was just too great. And we were pegged as deniers. And the amount of traction we got was in the academic world and in very small areas. The most vulnerable, frankly, who they see it. They say, putting up a windmill wasn't going to save, Central America last week. I mean, from the hurricane. We're just in a different world. And because I was so close to the numbers, I had to do something.
Ken, in that whole debate, what we've been searching out authors, scholars, politicians, leaders of any kind who really have added or can add, thoughtfully to that debate. Who are the 1 or 2 people that stick out in your mind?
Well, probably the one who's the most vocal and most prolific writer is Bjorn Lomborg.
Yeah.
And he really influenced me and got me. I mean, I read his book, The Skeptical Environmentalist, because he's an environmentalist. And he went, that book was an epiphany for me. I went to Edinburgh to meet him and have become friendly with him. And I love the way he thinks because it's practical. It's real world practical answers. And it's, the climate issue is so hard to put your fingers on, and people confuse weather with climate and people don't know the numbers. And so all that trouble, but yet everybody's for a good climate, so everybody can talk about it. So to me, there's something missing there. And he's really, really good at bringing it to a level that people can understand.
We totally agree. We had him on a few months ago, and he did a spectacular job. And he's very upbeat and positive.
Right. He wears really cool crew neck black T-shirts that I would love to be able to pull off.
Which is instant credibility. But none of the rest of us can pull it off.
I know. I put on a shirt for this.
Well, Ken, this has been in oil and gas terms a gusher. Like, wow, this is fantastic. We knew you'd be great. Let's wrap with what has you most upbeat about what's to come next year? Like when you have a real spring in your step, what is giving you that enthusiasm?
Well, it's not oil and gas, but that's not because of anything negative. I think we're in an age of discovery that we're in the beginning of an age of discovery. And things like deciphering the human genome, quantum computing, which are computers that are 1,000 times faster than today's computers. They can answer a question before it's asked. These are wonderful. Whether it's the medical field or the computing field, I think these are. We are really, now we're playing with fire in certain circumstances for sure, but we have a real opportunity. There's going to be major advances, and I read a stat the other day that 50% of the babies born today will see their 100th birthday. 50%. Okay, I mean that's a stunning. What does that mean for economic growth? What does that mean for social issues? There's a whole host of issues, but when I think about the issues that we're going to be confronting, I think it's around technology, AI, the ethics of AI, the human genome, the ethics around deciphering the human genome. It's fascinating, and COVID has accelerated that. I think we're seeing the application of technology and people willing. People. Zoom has been around for a long time. There've been teleconferences. Cisco's been selling gear for teleconferences for 2 decades. And now all of a sudden people can't live without it. And
that's like a phone call. I need to see your face.
That's right. So anyway, I think that's what's exciting, and it's going to push us. It's going to push humanity to a real to answer some questions that we haven't necessarily answered, and it'll make the Paris plan look like chicken feed when we think about what the planet's going to have to coordinate.
Wow. Well, that's a fantastic place to end. Ken, we can't thank you enough. It was so much fun. We might have to try to get you back, and we'll give you a respite, but the world's going to keep changing, and we'd love to keep hearing your views. For all of you out there, you'll see this on Wednesday morning. Have a wonderful Thanksgiving, but get ready because the Close of Business team has a really fun surprise for you for Thanksgiving Day. We're going into action. I won't preview it. I don't want to hype the market too much. But we've got a fun plan, and we'll look forward to sharing that with you. But have a great Thanksgiving, and thanks for all you do for us and the world out there in energy land. Bye, guys.